I'd like to invite here on the stage the CEO of Finance Latvia, my colleague, actually. I also took more responsibility for Finance Estonia recently. And let you, Uldis, invite your distinguished panelists. I think this is the first time when you have three ministers on stage together talking about capital markets.
Absolutely, and it's a great event, and it's great to be here. And I would like to use this fantastic opportunity to warmly invite to the stage the three ministers of Latvia, Lithuania, and Estonia. And let me start with the Minister of Estonia, Mr. Jürgen Ligi. Minister of Finance, Kristupas, Vaitiekūnas, please. And Minister of Finance of Latvia, Arvils, Ašeradens. And we will also be joined by the Vice President of EBRD, Burkhard Kübel-Sorger, please, on the stage. Great. So expectations are high, and let's start the conversation. Actually, I must say that yesterday's dinner prompted me to change the script, and I would like to start by a quote from a favorite person, I guess, of all of us, Martin Wolf, who is one of the great writers of Financial Times. He writes great editorials, and he has written a book called Crisis of Democratic Capitalism. And his main idea is very much about what has been said in the morning by the governor and also by Robert Sidelsons from Signet and by Prime Minister, that a strong economy needs strong capital markets. And I would like to extend that thought maybe one step further, and maybe argue of what happens if we do not have a strong economy. And I think this is what Martin Wolf has written his book about, where he outlined clearly the dangers of when economy is not meeting the needs of the people, and when ordinary people don't see the fruits of their work, and when society cannot meet essential needs such as defense and increased prosperity, you have all kinds of problems showing up, including populism, including identity politics, including radicalization, and these type of problems only persist. So just to kick off the conference, I wanted to little bit maybe start from the process of outlining what are the risks if we do not get things right. So that was a short introduction, so just to know who are on the stage. So Jürgen Ligi, the Minister of Finance of Estonia, is also a long-serving member of Parliament, and he has, of interest for the audience, held the role of Minister of Finance even before, including after the global financial crisis, and also served as Minister of Defense, Foreign Affairs, and Education and Research. And he has solid background in international economics and one of the most influential voices in Estonia on financial policy and governance. And maybe a fun fact, which was not provided by his staff, is that he's also a triathlon runner, finishing his last triathlon, as I checked, in 6 hours, 19 minutes, and 14 seconds this year. So, Minister, very warm welcome. Arvils Ašeradens is, for now, almost 3 years Minister of Finance of Republic of Latvia, but he has been a long-standing member of political community, being Minister of Economics, Deputy Prime Minister, and prior to engagement in politics, he has worked as entrepreneur, press publisher, long-time board chairman of Diena Media, and also been on the board of AB Maria Berg, which is the holding company which owns Swedish newspapers such as Dagens Nyheter, Express, and some others. So, and he has a solid background with a master's degree in economic geography, and he has also been the board chairman of Vienotība political party. So, Arvils, very warm welcome to you. And Kristupas Vaitiekūnas is a Minister of Finance of Lithuania, and before being appointed as a minister, he served as Vice Minister of Finance, overseeing tax policy, financial market policy, financial policy, and European Union and international affairs. And he has also been instrumental in recently securing increased funding for defense and other priorities that the country is currently facing. Mr. Vaitiekūnas has a master's degree of international finance from Vilnius University, and I learned also that he has very close link to Latvia, as his father was a long-time ambassador of Republic of Lithuania to Latvia. So a very warm welcome to Riga.
Thank you.
The fourth panelist is Mr. Burkhard Kübel-Sorger of EBRD, Chief Financial Officer, with a long background in JP Morgan, having served as Chief Operating Officer and Chief Risk Officer, and lately as Chief Financial Officer, and having also several senior roles at Association of Foreign Banks in Germany. And he's also a member of the EBRD's Executive Committee. So welcome to Riga. And again, looking forward to a great discussion. I would like to return to a number that was brought up by Prime Minister Silja, saying that recent opinion polls show that 62% of people, like ordinary people, like voters, actually support IPOs of state-owned companies. And state-owned companies, in fact, are the engine of I would say, boosting the market cap in any countries where you look at. It's an essential component for kicking off, especially the equity market component. So my first question would be to Latvian Minister Arvils Ašeradens. So how would you characterize, what is holding back the government for over 30 years from those important decisions, and what can be done to actually perhaps demonstrate that IPOs of state-owned companies is a doable proposal?
Thank you for the question. And I'd say somehow it's for Latvian society is quite painful, and for 3 decades we had difficulties to overcome to this issue. And of course, if we look on company structures, and half of top 10 companies are controlled by government, and that is last decade we spent on political debate. Do we going for IPOs or not? And I would, if you address this issue, I would like to then, slice down this issue in 3 fundamental segments in political debate. Number one is there is still Latvian society have very bad memories about privatization process. And still we have in parliament people who says in the beginning of 20s we had been struggling for not to privatize anything, and we put in law bans on restricted not to privatize state entities. And please don't examine this again. We will go on streets. Second is very interesting debate around, let's say business and society. And there is, in a big part of the business, there is strong beliefs as state-owned companies should serve needs of business. And companies should not make profit. The government-owned companies should not make profits. Yeah, and those are strong beliefs rooted in like way how we organized, for example, free ports and free economical zones. These are non-profitable entities, and mainly there, for example, in ports, the only capital gains is done by, let's say, companies cooperating in ports, but not government. Yeah, and this is attitude is, for example, towards, and there's on very serious faces are people speaking about, for example, energy companies. They're saying, energy companies have to provide cheap energy and not making profit. We have to make profit, and we have recent debate on, for example, Latvian forests, the same thing, yeah, and these political political parties and representatives economy say no, we're objecting against IPOs. We don't want to move on so to say, on free capital market. We don't want to put those companies in free flow on capital markets. And last one is another very important aspect is, and this is important to put it in mind, that is, I might say, define it as we are not there yet. Yeah, and you know, they were defined that every IPO need a great story and great growth story and trust. And if we look on Latvian government-owned entities, our Baltic, right now we have a new ownership structure, Lufthansa on board, the new CEO starting from 1st December. We just sit and wait. Then, like two telco companies, what Latvia owns, LMT and TET, they are under restructuring. And the game is requires to be on an IPO market, but we are not there yet. Then Latvenergo. Then is next gen Latvenergo about green energy production. We are in pipeline. There is a fantastic bond issuance, but we are not there yet. Yeah, and I would say all those three factors adding to this. Elections and have an influence too. For example, Riga government has quite an ambitious plan before regional elections. Had Riga Ūdens, Riga Water Company, and Riga Namsanieks put on stock exchange. No, before elections they were ambitious, but said let's wait, after elections we will do. Not now, and right now we're facing similar situation with similar situation with next year elections, and let's see political parties putting issue on hold. Again, we're planning to be in December, end of December after budget approval, to be in government with political debate. I have a strong passion and patience to push this file forward, but I think we will go to design plans for 26, 27 there.
Thank you, Minister. Does anybody want of the other panelists to make short intervention? Okay, you still have the opportunity to do that over the next 33 minutes. So let me then turn to you, Minister Vaitiekūnas. You have been instrumental in ensuring that Lithuania is ready for the challenges we are currently facing in the current geopolitical situation. So how can capital markets be used to help you in meeting those increased needs of defense, security? Can capital markets play a role in that?
That's a very good question, and actually it's very linked to the very first statement of yours about a strong economy and strong capital markets. And I would say that it's even more substantial because a strong country needs a strong capital market. As we see it from our example in Lithuania, and probably in Latvia is the same. You're preparing for the defense, increasing the defense spending. The demand for all this money and funding is it's huge. You cannot do it from your internal capacity. You cannot raise taxes to meet these needs. You can do it by little steps, not to harm the competitiveness of a country, and that's where capital market is an answer actually. Because people, the society, I think in all Baltic states, they have huge funds in deposits where they don't get any interest. They just keep them in the banks. And of course, this money could be used to increase the security of a country, increase our defense capabilities. But there is an obstacle. And I think the main obstacle is, as my colleague mentioned, it's the trust in financial system. The people in our countries, they had a very difficult history with the financial system. The banks in the first decade of our independence, I don't know if Latvia had the same issue with private banks. So now it's stable, it's good, but the history is not easy with that. So we have this huge challenge of financial literacy. And if we make it through this, then we succeed. Our markets will deepen, and we can borrow from them. We can keep the money in the country by borrowing, not to send them abroad as we do now. And we started doing this. We are issuing the defense bonds in Lithuania. It's the popularity of this instrument, it could be a lot higher than it is now, but you have to find how to persuade people that it's safe, that it's better than to keep the money in the bank. You have to establish new channels for them to invest, the easier way to invest. That's we have a lot of challenges ahead of ourselves and a lot of work to do.
Well, thank you. You said something that caught my attention, that it would be very good that more of our money would be working locally.
Yes.
And I would like to maybe turn to your Estonian colleague, Minister Ligi. Do you also think that it's a good idea that the Baltic savings should work increasingly more in the Baltics? Or why should we not, just to be very maybe incorrect politically, but why should we not allow people to benefit from the growth in Magnificent Seven? We know our pension savings are working to a very large extent in the United States. What is all this debate about local investment? I mean, we are currently in Latvia region in Latvia. Should Latvia money work in Latvia? Sorry for maybe putting it too bluntly. What is your view on that?
Well, it's good to dream that Estonian money should work in Estonia, but actually we shouldn't build any artificial restrictions for that, and to take local risks for investments administratively. And the financial market should be international, but of course the problem is not to build, the aim shouldn't be to build any barriers, as the political ambition sometimes sounds, that to take them away and to make investing in Europe, in Estonia, more easier, to make to unify the regulations, to have similar even culture. There certainly will always be some national barriers, language, behavioral barriers, but we should have less regulations for differences, for example, handling insolvency or protecting consumers. So easier rules, better information, of course, more financial literacy helps. So if it's said as if Mario Draghi has suggested to invest European money to Europe, I don't think he meant any artificial measures. He was dreaming about the statistical outcome. It's for Europeans, for Estonians, it's easier to invest in America than, for example, to Italy, and in the case of Italy, it's the same. So no artificial regulations are necessary. And in case of course, pension funds, which is increasing property, financial property, which is by GDP, the share of it is at least in Baltic states steadily increasing. You shouldn't press them on local market artificially again. But saying that, I have to admit that there is an initiative which is not public yet in Estonia as well. I maybe probably initiate how to make pension funds to invest more Estonia, but it's again not so artificial, but because pension funds do not actually work very much on the shares, analyzing them, that most of the work is index funds, which is very cheap work. So regulations about the fees that they can take from consumers should be a little bit different, whether it is investments where there is real analysis behind, or index funds. So I think we will change the rules, but it's not that artificial. This is taking into account that the fees are too high in cases of index funds.
Well, I think what you said is very important, because it appears that the whole debate is rather about creating enabling environment that allows and incentivizes money to flow in the same way as it's easy for money to flow out if there are good opportunities where people and the savers can benefit. But you mentioned the EU Capital Markets Union, and also that was mentioned by Prime Minister Silja. In fact, this is not a new project. It's been a very old project, and I would say maybe 2 piecemeal projects so far, but now we see a couple of tangible initiatives coming out, including recommendations of investment and savings account coming from European Commission to incentivize retail savings in capital markets. So I would like then to turn to you, Mr. Kübel-Sorger, on a more broad topic. Given where we are in the Baltics, what are the lessons from maybe other jurisdictions and good practices that we could think of in developing capital markets, and perhaps particularly the equity segment, which seems to be maybe a bigger problem?
Yeah, so thank you very much. Maybe first to say why I'm here. EBRD had been, let's say, supporting the Baltic countries since 1991. And at the moment, we have 200 projects that we invested in a total amount of 2 billion. And we promote the private sector, we promote economic governance, and therefore also the development of capital markets is really important. And we had been at the side of the Baltic countries in developing the capital markets since, well, 2017. And congratulations what you have achieved. And the latest step is actually the index of the advanced frontier markets. But now we need to think ahead. The next step is getting the status of emerging markets. Quite honestly, international investors don't need the Baltics, but the Baltic countries need international investors. And there the question is, how do you make your market more attractive, especially in the equity segment, for international investors? And the status of an advanced frontier market is more or less recognizing all the efforts that you've done in setting up an infrastructure that is up for international standard, regulation that is standardized. So you have done everything in order to set the framework. Now the next challenge is how to get liquidity, the necessary liquidity for equity listing into your market. And you mentioned already, let's say, partial listings of SOEs. It's not about privatization, right? That's another step. But again, first of all, not selling existing shares, but only actually when you issue new shares, actually put listings out and indicate also to the market that also the sovereigns, the government, is actually now putting trust in international investors. I think this is a very important signal to the market. Then if you look at, let's say, further expansion, it is about building a network. So if you have all your let's say, private sector entities that might want to go for an IPO, local listing is not good enough. You need to have a dual listing. You need a partnership, let's say, with either Euronext, with Deutsche Börse, whoever, because studies actually show that, again, you actually more or less triple the value of your IPOs if you actually go for dual listing. So you open up, again, your market for international investors. And I think that is another step in order to, let's say, build those partnerships. It might be first maybe with Scandinavia, building more or less expanding the pan-Baltic network into Scandinavia, but also look towards bigger European markets in order to get a listing there. And then, of course, the last element is you need to broaden your base. It might be on the issuer side that we've just mentioned, but also investors. It might be retail investors, and I think you have already mentioned it, in terms of offering the right products. It might be also looking at tax benefits and also how can actually pension funds play a role. The discussion around local money needs to be invested locally, also pension funds, I think is too limiting. It is more the question how to attract international investors, and then also the questions about local pension funds investing locally is no longer as relevant.
Well, excellent leads. Thank you. There is one point where we, I think, can debate, and that's the value added from dual listings. I personally am not convinced. You know, as a former president of Riga Stock Exchange back in 1996, my main priority was here to establish world-class infrastructure, and that's why the exchange was sold first to Finnish Hex, then to Swedish OM Group, and then finally to NASDAQ. That's why we have NASDAQ exchange here, a NASDAQ depository. Whether there are value added from additional dual listings, I think it remains up to each issuer to decide. But I think it's important what you said initially about the importance of world-class regulation, world-class infrastructure. That's very key. But of course, we live in a competitive world, and dual listings might be something to consider. But if anybody wants to delve into that discussion, if not, I would put one additional lead from what you said on importance of domestic savings, and then I want to turn to primarily the Estonian minister, whose country has some experience in demobilizing domestic savings in the second-tier pension reform.
Yes.
So what happened?
This is the silliest thing Estonia has ever done, I believe. Demolishing the three-pillar system was idiotism from 2021, I think it started. The outcome, of course, was increasing inflation and boom of consuming, not party of private investments, which was promised that people are starting to invest it. Of course, some people paid back the consuming loans, which were very expensive, but it's stimulating the system to take it again and to have this easy money is actually demoralizing for consumers as well. So it was bad for general macroeconomy and behavior of the people, though survey shows that Estonians and Swedes are the most financially educated nations in Europe. We didn't feel it. 250,000 people have left the pillar. Now we actually want to build it up again. Our government is very fragile minority in the parliament and no rating anymore, but still we will try and take to the risk, though there will be elections, and the ones who did it probably want to attack it once more. But this time I think we will be more clever. We may make the system a little bit more flexible to make it less attractive to demolish it. You can then use part of the pillar. You can return to the system quicker than the ones made. That is, if you leave, you can't come back until 10 years. Now we shortened the period. The period is necessary, but of course the future of Estonian pensioners is quite dark. 250,000 have left, and we'll get one third of lower pension or even more in the future. And at the same time, so we made a possibility to pay more to the pillar. And the outcome from the first round is that 90,000 people are paying more to the pillar. So, but the difference, the social differences in the future, of course, are frightening. In general, it's all the prestige of savings and everything was compromised in Estonia, and so don't try it at home.
Well, thank you for an extraordinarily honest and straightforward answer. I would then like to turn to Minister Vaitiekūnas. I understand that there are also decisions in Lithuania that go a little bit in that direction. So what is your take on it?
We always try to catch up with Estonia, and apparently we followed their example, and we in the middle of this process as well. But why it was made in Lithuania, it's actually quite an interesting topic, because I know both is perspective to the second pillar, the one that it's very, very good and the other that it's very bad. And we often have these TV programs or radio programs in Lithuania where experts sit down like today we do, and they discuss about this change of second pillar, and everything goes very smoothly until somebody calls to the studio from people who already retired or are going soon to be retired, and they share their experience, what we get from this second pillar pension funds, and usually it's about 20 or 50 euros additionally to the pension, which state pension is about 700 euros in Lithuania. So you get additionally 20 or 50 euros from second pillar, and that's people who've been in second pillar for 20 years because it was implemented in 2004. Why it was unsuccessful? Probably it wasn't unsuccessful, it was successful, but Lithuanian story in these 2 decades from 2004 was even bigger success, faster growth, bigger gains from investing in anything, in real estate, and so that's a unfortunate thing that happened to the second pillar program in Lithuania.
Just to reflect on what you said, I think also when it comes to the Latvian debate, and Minister Ašeradens may chip in, when the system was designed and launched in 2001, 24 years ago, at that time, Latvia or any of the Baltic states, none of them were members of the euro area. They had their own national currencies. Also, memories of the banking crisis of 1995 were pretty vivid. People were not convinced that investment in equities is a great idea. I think initially we had a limit of like 25% of total pension fund assets, second tier, that could be invested in equities. The asset managers did not know who their customers are. I think now it's only for the second year that they know who their customers are and can actually recommend investment option that is proportional to their risks. Fee regulation came quite late, so to be also self-critical on the financial community side, that regulation came quite late. So effectively, you had a system where a lot of funds were invested in too low-risk assets for too long, maybe charged high fees, and the risk level was disproportionately low for most investors for a very long time. And at the end of the day, you have then a story where if you look at performance in a very long time period, it's difficult to explain that it has been a great deal. Now, if you do all these things right, if you make sure that people invest in sufficiently risky assets early on in their professional careers, if you manage to have a sufficient competition so that the fees are appropriate, and if you manage to ensure that over the life cycle people adjust their portfolio composition, I think it's very difficult to politically argue against it. But we have a history, and that's something that we cannot take away. I don't know if there are any reflections on that, but I really understand the challenges. And if you have, coming again from what I started with Martin Wolf's point about crisis of democratic capitalism, if you have populists coming to power and saying, hey guys, this hasn't worked, some people may think, oh, these guys may actually have a point. Okay, then I have to grill also the Latvian minister about something. Mr. Ašeradens, you remember that a year ago, Latvian government increased the capital gains tax from 20% to 25.5%. And it seems a little bit that this goes into the against the stream of what everybody else is doing. I just looked at our neighboring country, Sweden, which has increased the tax-free allowance for investing in the in investment and savings account. There are many other countries contemplating on what to do to facilitate retail savings. Now, in terms of the tax policy, it seems that we have taken the opposite approach. If you had more time and better political partners, would you have done the same a year ago?
Let's start with discussion was before. Thanks God and thanks to Latvian politicians, we don't have any, interesting political ideas to demobilize the second pension pillar. It's opposite. There's strong interest to keep it functioning. Regarding capital gain tax, yes, and there were, very complicated trade-off on between tax reform and how to finance tax reform on 25, and there were agreement on in order to balance budget and rising defense cost. That was only way to do tax reform. Yes, we at the moment analyzing impact, and one of the saving arguments for government at this point was the system that we have, that is investment account regime, which allow you to deter losses and from in your portfolio, and then in a case when you really divesting money from your portfolios, then only pay tax. But I have to say, with what already mentioned, debate on government, how to develop, how to grow, even how to accelerate the growth of capital market in Latvia. This will be part of the debate on the taxation on profits. Let's say on debt market or equity market products or financial market products that we have in pipelines. That's an analysis, and we carefully analyze Scandinavian or particularly Swedish system, and we will come with proposals to adjust this tax fee.
It's very encouraging to hear. Would Lithuanian or Estonian ministers have any reflections on use of a tax policy as an instrument to mobilize domestic savings and encourage people to take higher risk with their investments?
There are a couple of them which we are implementing already. One is, of course, the tax deduction on pension pillars. The second is we have an investment account for people available, where they can, they have very simple tax regime, 20%, and they can accumulate capital. But in general, I'm always very careful against artificial incentives. But in these cases, we have done it. I was also finance minister during the latter thing, that is the investment accounts. Then we introduced that, and pension reforms, I believe, were at the same time in the beginning of the century, where we started with tax incentives.
Yes, we also have this investment account. The new instrument started in the beginning of this year, and the idea is that if you invest through this account, it can be any account in any bank, you just state it as an investment account, and you pay personal income tax only after you're taking the money out of it, not when you're making a profit. So that's an initiative to make people invest more.
That already was mentioned, but the Baltic capital markets, they are harmonized around the Baltic states, and regulations is similar one. But just adding to the tax discussion, I would like to say what Latvian government did, maybe this delayed, but very important, we call this package thin capitalization rule. That is, how to say, we harmonizing capital access rules between banks and private sector. That means that allows for companies to lend financial resources in same conditions as they're lending from banks, and that is related to previous discussion. We have to blend sources, not only banks could be main channel for financing, but we're stimulating the financing capital, the company growth by all other channels too.
It's an excellent point, because I just wanted to thank for front-loading these initiatives and making them sure they happen already next year, because that indeed would stimulate both securitizations, but also non-bank financing, as all channels are welcome for the economy. Now, maybe since we are heading towards the end of the debate, may I quickly ask each panel participant to maybe outline just one idea of what could have a significant impact on further development of Baltic capital markets. So I offer anybody to start the answer.
Well, what I heard so far is, I would say, very mixed initiatives. And I think one needs to be really to simplify the access for retail investors to participate in the capital market and the private, let's say, sector investments. I think this is important for a country, for stability, for resilience, but also challenges in all of those countries cannot be handled just by the sovereign or by the financial industry. You need the private capital market, and you need to unlock retail savings. And therefore, anything that helps to simplify, it's not just literacy, but it's really digitalization, but also simplifying tax schemes around this. To have a strategic view is, I would say, the first priority.
I would agree that simplification is definitely one of the directions that we must move on. And the second thing I think would be we have to take the new reality we are in now, and we have to take more risk in this in capital market. We must we should enable pension funds to invest more freely, take more risks, and because it's just a new reality we encounter. And of course, financial literacy for the public. In any way we can do that, it's a must in today's world.
Well, I can't mention one thing, but there's a lot to do, and of course, for Latvian government, debate on state-owned entities, IPOs, is fundamental, and we have to go on to discuss until the point of understanding, and that's very important. Second, of course, is a very important issue is about development of ecosystem. Already the description for this excellent, harmonized MSI indexes, everything, but I think what is desperately needed, that is access to Central European depositories. And we already negotiations with Euroclear. Of course, it's costly. We have to find a way how to solve but at least that is those are two important points. And I fully agree with retail infrastructure, infrastructure for retailers, or this is something what we see there is a problem. How to usually, let's say, investor could access the capital market and could easily deal with to invest easily and have control over what he is invested products.
I think the big thing that would certainly work is to shift our neighbor away from our borders, and I do not mean Latvia here. But if we fail in this, there are other ideas as well. For example, join the stock exchange of the Baltics and Nordics, and in the future, the European ones. And there are things we shouldn't do. One is messing with the pension system, not messing it.
Well, thank you for these ideas. And actually, I was asked to have a controversial debate, but it seems that we are agreeing here on many of those matters. And also it seems that the general theme that runs across this debate was that we want to have more integration, we want to have more involvement in capital markets, and we actually want them to grow. Now, coming back to where I started with Martin Wolf, he said, you know, many people are accusing me of being pessimistic, and if one reads his book and his analysis, which is knife sharp of our societies and the risks we're facing, including his point that if we are not fixing the economy, so people will be looking at more authoritarian states and look how they have succeeded to fix their economies and to deliver better results to their people. So people may be questioning the very grounds of our societies. So from that perspective, doing everything possible to make our economy resilient, strong, and growing is key. And he said, you know, the advantage of being a pessimist is that sometimes reality surprises you in a positive way. And then after this conversation, I think I have become a little bit more convinced that this actually can happen. Thank you.
Thank you.
Don't go yet, gentlemen. We have questions. We still have a few. Still have a few minutes. Yeah, now maybe too controversial. I don't know. It depends. Just shout if we need to leave. First question is, as we are in Riga, then for the Latvian minister. So it appears Latvian citizens are supporting the listing of SOEs. Will you use that momentum to progress on that? And what progress can we accept during your term?
Again? What is the question about?
So will you take this momentum of the Latvian population that the SOEs could be listed, and what can we expect during your term in office?
I can expect on the government there will be agreement on what should be done on 26 and 27, not before.
So something to look forward. 26 is soon.
Yeah, I
coming. Another question for a Lithuanian minister. So you mentioned this a little bit about the pension reforms, but what long-term effect do you expect from the pension reform?
About long-term effect, it's a little bit harder to say, but maybe I answer about the short-term effect, what we expect. Of course, next year we expect to have a little bit faster GDP growth, a substantially increased spending from the public, and of course a little bit faster inflation. This effect will last probably for mainly 1 year, but we will see something in second year as well, because people will have a gap to leave. It's 2-year gap, but probably most of them will leave in the first year. And to answer as what is the long-term effect, it's actually hard to say, because today the geopolitical situation is so unpredictable that it's really hard to predict what will be in 5 or 10 years. Of course, these people who are leaving, they're not getting this money in the future, they're spending them now. They have to understand the trade-off and make a careful decision.
And I'm not sure who wants to take this, but what do you think of the idea of integrated Baltic capital market supervision?
This was idea provided, as we heard in Vilnius, by SM researchers, and I like it very much.
Okay. As we're ending...
Karel,
yes.
And I just have been thinking on your question, and I think I see my function here is as election is next year. I really hope I somehow will manage to break the ice and convince political environment as a capital market development and rapid development is fundamental for Latvia and Baltic states' overall general economy development. That's
it
my
sure
answer.
is, and great to hear. And I think what we have been, at least certain stakeholders, seeing now that the European Commission is also warming up again, that capital markets are something that need developing. They even have a new name now, not the CMU, now it's SIU.
Yes.
Hopefully this will be more successful, but I think we need to keep in mind that, and I think our minister was spot on, that we can't force investors, to force them to invest in Estonia, Latvia, Lithuania, or even Europe. And there's a reason why money is pouring into the Magnificent Seven or 10 or however you name it. I mean, they are driving the global economy, right? If you take these 7 companies out, then the 493 companies in the US are performing as the European stock 600 and the Baltic, really. Pretty much, not going anywhere. And the reason, I think, is that we haven't seen widespread economic growth for many, many years. And this is what is driving investors to one region or the other. So our job with Policymakers is to make sure that there is no barriers. That if an Estonian investor wants to invest in France or Stockholm or the US, it is possible. And it's possible also the other way around. And as Burkhard said, that we need the institutional investors, not the other way around. And what we have seen is really a legacy of barriers inside of Europe that make it difficult for our companies, our unicorns, for example, to go and list where they are known best. So they need to look for regions, where historically the institutional money is going. So this is something we can change. Yes, you have a comment.
I think you should be excited by the perspective of getting into the status of an emerging market. And you outlined already in your introduction the benefits. And if each of the countries would commit in the next 2 years to have one of their SOEs publicly listed, it will more or less make that step towards emerging markets. If this is, let's say, the objective to get there, because then you get the inflow from international investors, and it will help to promote and to foster your economy, then I think this is like the step that each of the countries should commit to.
Exactly. Great comment. And I thank you, gentlemen. Great panel. Big round of applause.
Thank you.
Okay.